I trust you are well, and welcome to Trader Talk Radio, the last one just before Bali. So I'm sure you're all looking forward to Bali, and I'm looking forward to be there as well. If you are there live, let's catch up, have a coffee, just catch up and talk briefly in the corridors, whatever we're doing there. And if you're not live, I certainly hope that you will be online. A lot of traders, different trading styles, and I'm sure you'll find something that resonates with you. So yesterday, I took a trade on USD here, and I got out here just about 3 to 1 to 10. I will talk about that, but before I get to that, I want to just take us through the whole USD yen, Japanese yen, for the day up to when I took the trade. And this will give you an insight into how I'll be trading in Bali and how I trade, how I'll be trading in Bali. I'm looking at currencies. Can you imagine that? For a long time, my trading was around indexes in one particular one. But over the past 7 to 8 months, it's been a complete evolution. So I'm loving currencies, enjoying them. And guess what? Same thing I've said over and over again. Price action is price action. If I hit this name here and I hit the time frames up here, there is no ways that any one of us, no matter how seasoned we are, could tell if what this market was. You would never guess it correctly. It could be oranges or oil or gold or currency or commodity or a particular stock. Price action is just price action, and the patterns that you see in one market, you're going to see in other markets. The patterns you see, price action, and the patterns are fractal. The markets are fractal. The patterns that you see on this time frame, you're going to see on different time frames. So it doesn't matter what time frame you trade. As a price action trader, it is all the same. So all I have is this EMA, George's EMA, the 10 EMA that I use. And I'll tell you about that a little bit more, and maybe in Bali as well, if you don't know how I started using that. So right in the Asian session, we had a lower high double top. Bears broke out, pulled back, and then with another breakout. So you could trade this as a breakout from a double top, and you put your stop up here. You also can trade the breakout. So I say to guys, you can trade the breakout, understand that breakouts fail more often, or you can wait for a breakout pullback to trade the breakout pullback, and I'll show you some of those. In this case, if you trade the breakout, you need a stop that is above the breakout. Look to the left, technical level that is there, breakout, and it fails, either get out of your trade or hold on, and hopefully you don't get stopped out. You might have been stopped out here with the spread. Lower high double top, bear breakout, you can sell here, breakout trade, stop above here, and then just hold on. If you don't want to trade the breakout, it's perfectly fine, because maybe you want to wait for the pullback. Higher probability to trade the pullback, less profit left in that particular structure, the breakout pullback, the leg 1, leg 2, which I'll show you just now as well. But you also don't know whether you're going to get a breakout. So when I talk about the trade that I took a little bit later on, I took it as it was in breakout, and I was very willing to trade the breakout pullback as well as a scaling, but we never got that until the market moved quite a bit. So it's one of those things that you gotta decide to trade subjectively. Either trade the breakout and the pullback, or just wait for the pullback. Perfectly fine. You trade the breakout, there is a stop. Then you wait for the pullback. Now, if we'd had 2 strong candles, then I got a doji, I would consider that a pullback, but 2 strong candles beneath the EMA. So I'll probably just wait a little bit for another pullback. There is the breakout. There comes a pullback, low 1. So big bear breakout, pullback, low 1. Low 1 is the first attempt by the bears to resume the trade. It's the first lower high. Breakout, pullback, first lower high. Higher probability than trading a breakout, less profit. When you take that trade, in terms of your money management, use a measurement of stop. And you all know how to use measurement of stops. If not, I'll spend a little bit more time on that. All it is simply is the height of the candle. The signal candle, you want the same height for your stop. So you can put your stop there. Had you taken that trade, the moment you get acceleration down, you pull your stop to break even, and you can still take that trade. Fantastic. Now, how far is this market likely to go? You take your extension, Fibonacci extension, that's what I use this for. Look at the bodies. There is the first leg. There is the first leg. There is a pullback. Look at the first pullback. So the first target for the bears is to do the first leg. After the pullback, they want the equidistant move for this leg two, and they hit it spot on. When you see that and the market gives you a low test like that, get out of the trade. The move is complete. If the bears are strong, they'll give you another sell. So it would have been a fantastic trade for you to have taken. Had you taken that, at this breakout, that's a nice 2.5 to 1. Had you taken that as well, or just that, it would be 1 to 1. Had you taken the breakout trade and not managed it and get stopped out, well, made money, and been a pretty good day. So from here, bulls from the reversal. Now, why is that a reversal pattern? Why would you expect the bulls to go? Because a few other things have taken, one other thing has taken place. So the leg one pullback, leg two, that creates a hidden level of resistance. But also, if you look to the left, you know, always say once the market starts to move, look to the left and say, well, what did I miss? Well, we missed a wedge here. Market went down once, went down twice, 3 times. When the market tries to do something 3 times, there's other factors that tries to do something different. So now the bulls come in, bull breakout from the reversal. Tails on top, pretty problematic for me. I want to wait a little bit, but I'm now looking to trade. If this had been a bull candle, I would have gone through the same rationale, take the breakout trade if you want, put a wide stop in it, or wait for the pullback. But pretty weak breakout in this case, so you've got to wait a little bit more. Closing beneath the EMA, and then the bulls resume. So good resumption by the bulls. Got to find ways to get into the market. Tail, a big problem. But when I get that kind of candle after that price structure, happy enough to jump into the market, measurement stop. There is a measurement stop there. As soon as you get acceleration, pull your stop up, halve the risk immediately. If you get stopped out, you could have the risk in. Now, how far is this likely to go? Well, we still have the breakout, and that is almost, that's where we're taking the trade. But the breakout carries on. Breakout carries on all the way up to there. So you could say from here, breakout, there is a pullback. So the bulls who are seeing this whole thing as a breakout want to get as far as that. We didn't quite get there. So the bulls didn't get there. And we failed. Okay. Alternatively, you could consider and say, well, bull breakout, tail was a pullback, so maybe the pullback is actually a little bit early. Now let me move this. Bull breakout, fail breakout, that's the entry. And if you're taking that, if you have to go away, that's what you'd use. Okay. I'm going to say, my take profit here, I gotta go. I'll come back and see what happens. So you could take that. The moment it hits that, bank your profits because you put the take profit in. Alternatively, if you are staying in the market, which I like to do, is let it do that, wait and see what happens. Okay. Comes back, your stop should be a break even. If you hang in, it might have been stopped out a break even. Fantastic. Or, you know, that price action there, as soon as it fails and starts to come back, you get out. Now, the bulls try 3 times. They tried once, tried twice, tried 3 times. They tried 3 times to go to high levels and they failed. So we have a successive lower highs, which means the bears are strong because the bulls are failing to get up. So if that's what's taking place when you see the bear breakout beneath that lower high after 3 attempts, worthwhile for you to take the trade. Breakout candle, there's confirmation. You can take it, put your stop above the breakout, and put your stop above the breakout. If you don't want to take the breakout, you wait for the breakout pullback. Higher probability, less profit. And I like to use the bodies as the first target: breakout, pullback, low one. So it would have been fantastic if we had a signal candle much smaller, but that's low one. You don't know this is going to take place. You know that if the bears are strong, they can smash through the leg one, leg two, or come back. So if you take that and we get to the leg one, leg two, and you get a reversal candle, exit as quickly as you can and break even. By that time, you've pulled your stop down to break even. And then we just go sideways. Okay, so perfect, beautiful stuff happens. We get a double bottom, but within that double bottom, a little bit of a wedge here, full breakout beneath the wedge. So this is good for the bulls. Double bottom, lower high, higher low, wedge bottom. These lows are higher than that, and it's a wedge bottom. So bulls had a chance to accelerate up, they failed. They have another chance at the double bottom to accelerate up. Fantastic. If they'd given us a decent enough bull candle, we'll be talking of taking a breakout trade, wait for the pullback. But very weak breakout, nothing for us to do here except wait. Another chance for them. Another higher low, wedge bottom. Opportunity for them to accelerate up, but they failed to capitalize on that. And then the market has micro double top. But look at something else. From the, if you look at that, that's the high of the day. And the moment we had that high of the day, the bulls have failed to get up above that and above that. And they even failed, they tested that level, but they failed to get above that level. So you know the bears are strong. We are in a big trading range. The bulls are failing to take advantage of the opportunity. The bears are defending their lower highs. Now we have a bear breakout after the micro double top. So that's a decent enough reversal pattern, failed breakout. So you will hear me talk a lot about wedge bottoms, wedge tops, failed breakout, confirmed breakout, leg one, leg two. This is all just price action structures that give us indications that really show us what's happening in the market, where to take trades, where the profits should be. If you get stopped out, that's fine. We always talk of trying to create a basket of trades out of your strategy. So a particular strategy, breakout, pullback, low one, absolutely love that. Here, all the price action traders now starting to talk about it in ATW, and I love it, sweet music to my ears. Breakout, pullback, high one. Probabilities. When you take, so if your strategy is a breakout strategy, you know most strategies fail. So in a basket of 100 trades, if you trade in breakouts, based on pure price action, your win ratio, your ratio is skewed because you have 40% chances of success with breakouts. 40%, other 60% you lose. So you have to decide how to manage those trades. The ones that you lose, you can manage. But if you want to switch the ratio around and have 60-40, then you're going to trade the pullbacks, breakout pullback. It doesn't have to hit the EMA, so it's not an EMA bounce. It's a breakout, it's a pullback. Breakout, pullback doesn't get to the EMA. So don't confuse the two strategies. EMA bounce is another strategy completely different. So that's a higher probability. So that's when you get to 64. So if you just take these breakout pullbacks, high one, low ones, 100 of them, 60% you win, 60%. Some will be small wins that you take. Some will be good wins, 1-to-1, 2-to-1, etc. 40% you can lose. They could all be 40% times 1%. So 40% loss is a possibility if they all get hit. But chances are it will be less than that because you tighten your stop as soon as it starts to move, and that's how you reduce your losses. And some will be break even. A lot will be break even when you start to say, okay, I've taken that trade. It's not working. I am out. Don't hesitate. Just get up. Okay, so that's how you manage. But you need to understand how the ratios work so that you don't get yourself in a funk and get upset or whatever the case may be. Big trading range, micro double top, good for the bears, bear acceleration, breakout trade, stop way up here. Okay, you could have a more aggressive stop if you wanted, not above the breakout candle, but just above here. And it fails. If it fails immediately and waiting for a breakout pullback low one, there is a breakout pullback low one. It's a very poor one. Why is it poor? If you trade in the breakout pullback low one, you want everything to stay within the EMA. Okay. That can fail, but the next candle must be in, so don't take that. What you then get instead is a lower high. These highs are lower high, micro wedge. Why is it a micro wedge? It's a wedge top, but they're pretty close to each other, 1, 2, 3, few candles. Like unlike big wedge bottom, micro wedge. Fantastic. Okay, so lower high wedge top. So it's good for the bears. We had the breakout, we had the pullback, low one didn't trigger, but the micro wedge tops is still good for the bears. Had you taken that, pulled it down, tightened your stop a little bit, got stopped out, that's perfectly fine. Look at the structure. The bulls haven't taken over, so it's still favoring the bears. Okay. The bears come back after the wedge top. Bear acceleration after the wedge top, breaking out beneath here, near this level of support where they failed. Then when they breakout, pullback low one, there is a low one trade. I waited a bit because of the structure. I wanted just to see the bears just close a little bit beneath these levels, just like the bulls had broken up above here. I would have wanted the bulls just to give me a little bit of a close and I can jump in. So the structure I'm very happy with, but I had to wait a little bit. And then when I saw that, as clean as they come, take a trade, stop here. Okay. You said, George, why is your stop tighter? Because the breakout pullback low one was here. So if I didn't have all of this, if things were a little bit higher, I would have taken that, use the measurement stop up here. But I'm taking confirmation of this. I can use a tighter stop with that. Now, you can also consider this a breakout. You're going to decide, do I take the breakout trade or do I wait for the pullback? Okay, the pullback may not come for a long time. Okay, and you're going to make a choice. So I decided to take that trade. If I'd seen a decent enough pullback like that, I would have just jumped into the market. Breakout, fail, breakout, big tail. Had this been, a perfect doji, can you see one? See this kind of doji here? Had this taken place somewhere here, not as an outside, cannot be tails. That to be a reasonable enough pullback to take. Okay, but the market carried on and on and on. And eventually, I got out here. Could you scale in? You could have scaled in here, the big stop above here. You scaled in here if you wanted, with your stop still above here. That you could have done and jumped into the market. Or just trail your stops, trail your stops, trail your stops until eventually you get. Or here, I stopped myself out. Why did I stop myself out? Now, these structures and these patterns that you hear me talk about are absolutely key. Going to give you insights. When you have a prolonged breakout like this, chances are there will be a reversal pattern, higher probability reversal pattern. Market might go into a prolonged trading range and then decide whether to break out or pull back, or might just have a pretty violent, pretty strong pullback after a prolonged breakout. Sometimes you see strong breakout, big pullback, not breakout, pullback, lower. But George, tell us a little bit. Well, as you're observing all of this, and I was trailing my stop down, I'll show you I was trailing my stop. I see a tail. and say, okay. As long as the bears come and give me another candle like that, happiness. You can continue to trade, scaling, stay in the market. But then you get a candle like this, and now you have a tail. Okay. You get a bear candle coming in. Candle closing, it's low to have a high probability for you to try and take and see how much more you get. But you still get another tail. So unless you want to take a low probability trade, now we're getting indications that the bulls are coming into the market. They still can't stop the bears, but they're in because of the tails. Big bear breakout, tail on top, strong indication of the bulls, but they've done that all the way here. We might just carry on doing that and trickle away. But then we get an inside candle, then you get an outside candle. That for me indicates that the probabilities for the bears are diminished. And now we're going to a trading range of reversal. So I just exited my trade, banked it, happiness with that trade. So a lot took place in here. The ability to be able to look to the left, something happens. So you don't really have to track all of this. I do that because I'm used to it. You're waiting to see. So even, let's do this. You get to there. You see that, say, oh, my goodness. Are the bears taking over? Look to the left then and just get some assurance. Failed breakout, micro double top, there's all these low highs. Okay, I can take a trade. Okay, so if you didn't take that, and then all of a sudden, you see that, it's like, oh, do I take that trade? Well, look to the left, set to see, okay, bears and control. I gotta take it. I don't know what's gonna happen, but I gotta take a trade. And then that's how you jump into the trades. All right, guys, I hope you find that useful. I just want to show you one more thing. You've probably heard me more often than not say I don't trade news. And I want to just illustrate something. This is Euro New Zealand. It's not on my list. There's other good stuff that took place there, which I'm not going to go into. But I just want to illustrate something. When there's news that affects the particular market you trade in, so if you trade in the USD CAD, Canadian dollar, when they have their interest rate announcement, I stay out of the market. If there's one red news announcement, that red little highlight, flag on Forex Factory, I use 30 minutes to stay out of the market. If there's two news announcements, an hour, etc., just stay out. I know there's guys who trade the news and they're pretty good at it, but I stay out from a price action perspective because it's really good to say, oh, if we didn't have this tail, if the market had just sold, oh my goodness, if only I'd stayed in and sold, I'll be happy. But you just do not know when the news is dramatic. When things like non-farm come in, I just stay out. US CPI, get out. Interest rates, get out. For this particular market, but if it's interest rate for euro and you trade in the yen, you can comfortably trade the yen within structures without getting out. But when you know the news affects many markets, you just stay out. So I would have stayed out of the market, 30 minutes before, but this was all a trend. It was a big bear thing here, which I'm not going to go into, but I would have stayed, I probably would just now. Why not? I would have stayed out of the market, tight trading range. Because of the coming news, right? News, try to break out. Really doesn't matter. I'm not worried about it. But then I come back, so you can go get coffee, walk around, do whatever, depending on what time of day it is and where you are. Come back, after the news, 2-3 candles after, just start to look at the market and see what the market is giving. At some point, nothing trending. Sometimes you get trends coming out, nothing trending, but you get a lower high here. Still nothing trending, no consecutive bear candles closing beneath the EMA or both candles closing above the EMA. We then get a higher low here from the news candle, double bottom with that. And it's still gonna, this is one of the markets you're interested to trade in. So you're watching it and saying, well, I wonder what's taking place. Another big outside candle. Now we're in another trading range. So there's that. There's its low here. And within that, another tight trading range. Okay. So the market is kind of doing that. And you're wondering, what is going to happen? Should I just shut and go away now and it's done? Or, well, I said I'll be here for 3 hours after the news. I'm going to watch it and see if it's an opportunity. Then you start to get that. Oh, I got a bull candle. Strong bull candle. Why is it strong? It doesn't have to be huge. It's closing above this tight trading range. Small tails. It's closing above the high of this outside candle. That's good. If the bulls are strong, this was also good. They'll give me a follow-through candle. They give me a follow-through candle. And I'm like, oh, wow, now I have a confirmed breakout. Bull breakout plus confirmed breakout. That's all I need. Now I can start to say, if I'm going to trade it, I can take a breakout trade. Right here. Okay. For some reason, my laptop is slow soon. So I'm just going to mark it with that. I can take that breakout trade. Where do I put my stop? More aggressive at the beginning of the breakout or here. Because it might just fail. I might just take it and it fails. Because I'm taking the breakout. I know most breakouts fail. Or I'm going to wait for a breakout pullback. And guess what? Get a breakout pullback high one, breakout pullback first, high low. Measure move stop. It's an even better entry than the breakout trade. Does not always happen like that. Stop is here. As soon as you get acceleration, touching the stop to here, big candle, break even. Let's put a break even. And then your word is gone. Do I take a breakout here and put a stop here? You can. You don't know how far it's going to go. If you want to take a breakout and you've missed it, just take a trade. It may just go far, The bulls may want to just take this as far as it goes, but your stop is here. Now, a bit of a variation when you have a huge breakout. If you want, you can put a stop at 50% midpoint. Okay, not at, just below, because if the bulls are strong, they will not allow the market to come to 50%. Okay, it might just come back and accelerate up. So if you want to take that, you don't have to put a stop down. You can put a stop here if you want. Or I don't like breakouts. I'm going to wait. Breakout, pullback, high one, not the neatest of high ones. Maybe take that one, so an outside candle. You can take that. And measure move stop. As soon as you get some acceleration, touch move stop. Eventually, you have a failed breakout, come back to the EMA, close your trades at this stage, or pull your stop up, so that the case may be. So, point of this is show you some structures. I'm always looking for the market structures and trading off that. Putting measured move stops, tightening stops when I have to tighten stops, letting the news, staying out before the news, letting the news rush out, and then look for trades. So very quickly, I'm just going to show you this. I want to show you what I want to show you. I could go through the same structure, trading ranges, breaking out, etc. I'm not going to do that. I want to show you that leg one, leg two, which I showed you on the USD yen, how it would have worked in there. So you realize there's a bear breakout, and you look to the left. Oh, fantastic! Maybe jump in here or jump in there. Big breakout candle, stop above there if you want to take it. But you perhaps I'm going to wait for a pullback. Breakout, pullback. So when I use this tool, leg one, leg two, I look at two things. First, I look at the first pullback. There is the first pullback. Didn't get a trigger. Had we triggered beneath here, the bears would have wanted to get to that. Now I'm just going to wait and see if there's another opportunity. Market comes back to the EMA. Fantastic. Test the EMA. Decent bear candle, not an outside candle. I want to sell here. doesn't get triggered. So that's another pullback I look at. So I'm now wondering, okay, the bulls have got a close above the EMA. Maybe this is just a reversal pattern, double bottom, and whatever stuff is taking place here. For me to confirm it's a reversal pattern with bulls accelerating, there's a close above the EMA. I need confirmation. I don't get it. I have a 2-bar reversal. Try and sell here, don't get triggered. Wait again. So now I have a higher high double top in here. Still part of the pullback. So just keep pulling that up. We try to get up above it, we fail. Guess what we have now? We have a micro wedge. Try to go up once, twice, three. Micro wedge, micro double. Bear breakout, 2-bar reversal. Then I can sell beneath here. Happy to sell beneath here. I'm selling off the micro wedge. If I'm doing that, I'm going to use a measurement stop and put it there. Or wait for the breakout. Didn't get triggered on the breakout, you wait. But now you've seen, if the bears are strong, they want to get to a measured move down here. Okay. That's as high as the pullback is. They want to get down here. If the bulls are strong, this pattern is going to hold. Okay, so you took the trade. Fantastic. Go to stop up here. Pull your stop down. We don't get above the EMA. We continue to want to sell off. So when you start to see that, I will jump in here or here. Yes, I can see that, but I'm now trading off the micro wedge. Breakout, go back lower one off the micro wedge. So that's not good indeed. Okay. So I'm trading off the micro wedge. That pattern didn't succeed, but the micro wedge is in fact, so breakout, go back lower one, and take that or take that. And the goal is to try and get here by the bears. And you can see we have sold anyway in here. The bears go to here, reversal pattern, and then you can exit the trades. All right, guys, I hope that was useful. I sincerely look forward to seeing you live in Bali or catching up online in during Bali. Take care and have a good day. Cheers. Bye-bye.